Welcome. Today we'll be investigating the Vanguard equity income funds and how they have performed in the past, and a crucial part of that is understanding return on investment and expense ratio. So let's dive in. Return on investment, or ROI, is your profit from an investment, expressed as a percentage of the amount you've invested. It's the primary measure of an investment's performance, the yardstick by which we assess the efficiency of an investment. On the other hand, an expense ratio is a fee that you pay to an investment company to manage your fund. It's expressed as a percentage of your investment and is deducted from your returns. So, a higher expense ratio means lower returns for you, the investor. This is why it's so crucial to keep an eye on expense ratios when choosing your investments. This will be important when we evaluate VFIX and the Vanguard equity income funds. Let's consider other scenario. Suppose you're comparing the two funds. VFIX and VIPEX Fund A has an expense ratio of 1%, while Fund B has an expense ratio of 3%. At first glance, Fund A might seem like the better option, right? But what if I told you that despite its higher expense ratio, Fund B had a lower initial investment of $3,000 versus $50,000. This is where the importance of ROI comes into play as you accumulate more capital in your account. It's not just about the fees you're paying, it's about what you're getting in return, and if you could even qualify for the investment minimum. If VIPEX can deliver a similar ROI, even after accounting for its higher expense ratio, the lower initial investment barrier, then it might just be the better choice to start with. Then making a plan to later transition to VFIX once you accumulate enough capital. However, it's important to note that while ROI is crucial, it's not the only factor to consider. You also need to think about the risk involved, your financial goals, and your investment timeline. So it's clear that a fund's expense ratio can significantly impact your returns, and hence, it's essential to consider it while making an investment decision. Now that we understand the importance of expense ratios and the minimum investments, let's delve deeper into the world of investment funds. We'll start with VIPEX, the Vanguard 500 Index Fund Investor Shares, as our benchmark. This fund tracks the S&P 500 and boasts a solid compound annual growth rate, or CAGR, of 13.59%. It has a market correlation of 1, making it a reliable choice for market-aligned returns. The dividend yield is 1.38%, and the minimum investment is $3,000, with an expense ratio of just 0.04%. Next, we have VFIX, the Vanguard Equity Income Fund Investor Shares. This fund focuses on income, delivering a stable CAGR of 12.93% and a market correlation of 0.94. It's a balanced choice for income-oriented investors with a dividend yield of 2.84% and a minimum investment of $50,000. The expense ratio is slightly higher at 0.18%. Similar to VFIX is the VIPEX, the Vanguard Equity Income Fund Admiral Shares. VIPEX mirrors VRX with a robust CAGR of 12.85%, offering a slight edge for those seeking lower expense ratios. It has a dividend yield of 2.75%, a minimum investment of $3,000, and an expense ratio of 0.27%. Lastly, we have the Invesco QQQ Trust. This fund is focused on the Nasdaq 100, showcasing the highest CAGR at 16.90%. It comes with increased volatility, providing potential for higher returns and risks. The dividend yield is 0.68%, and the expense ratio is 0.2%. As we can see, each fund has its unique features and metrics that can cater to different investor needs. Whether you're a risk taker aiming for high returns or a conservative investor seeking steady income, there's a fund out there that aligns with your investment goals. It's crucial to consider all these factors, from expense ratios and dividend yields to CAGRs and market correlations, in making an informed investment decision. After all, investing is not just about chasing returns, but also about managing risks and costs. Let's talk about the delicate balance between expenses and returns. As investors, we constantly juggle the cost of our investments against the potential returns. It's a delicate dance, a balancing act of risk and reward that can make or break our financial futures. Consider this. You're looking at two different funds. One has a higher expense ratio, let's say 3 times more than the other. But this fund also promises increased dividends as a greater portion of its overall return. The question is it worth it? Now, if the higher expense ratio results in a significant increase in dividend yield, then it might be a no-brainer for someone looking for a yielding asset. But what if it only offers a marginal increase? What if you're paying 3 times as much in expenses, only to see a 1% increase in dividends? Suddenly, the cost effectiveness of this investment comes into question. This is the kind of scenario you might find yourself while you are looking into the Vanguard equity income funds. And it's in these moments that you need to weigh the trade-off between expenses and aggregate dividend yield. You need to ask yourself, is the potential dividends worth the higher expense? It's not always an easy question to answer. There are many factors to consider, such as your income goals, your risk tolerance, and your investment horizon. But at the end of the day, the decision boils down to this: is the higher expense ratio justifiable given the potential dividend income? If the answer is yes, then by all means go for it. But if the answer is no, then you might need to reconsider your options. There's no point in paying more for an investment that doesn't deliver the returns you're looking for, and in this case, the dividends. Looking into VFIAX, it outperforms the other Vanguard equity income funds by roughly 1%, but VEIPX and its institutional counterpart return an extra 1.2% dividend as compared to the S&P 500 benchmark. In this case, it's not so much about growth, it's about the how: by capital appreciation or by dividend. The bottom line is this: expenses matter, initial investment minimums matter, the dividend yield matters. They eat into and create your returns, which significantly impact your investment outcomes. So when you're considering an investment, don't just look at the potential returns. Also consider this and weigh them against the pros. Remember, it's not just about the income. It's also about how much you're paying to get that income. Let's take a moment to reflect on what we've discussed today. We've delved into the world of investments, specifically focusing on the importance of return on investment and expense ratio. While high returns are always appealing, we must not overlook the cost of achieving them. A fund with a high expense ratio, even if it promises increased dividends, may not always be the most cost-effective choice. Always remember to weigh the potential gains against the expenses. We also cast our eyes over a selection of funds from VIFAX, which tracks the S&P 500, to VEREX, which focuses on income, and VIPEX, the Admiral Shares version with a lower expense ratio. We even touched on the tech-focused Invesco QQQ Trust. Each of these offers a unique blend of returns, risks, and costs, and there's no one-size-fits-all. Your choice should align with your financial objectives and risk tolerance. The journey doesn't stop at choosing a fund. We also need to understand the trade-off between expenses and returns. A fund with a higher expense ratio might bring in a higher dividend yield, but is the increase enough to justify the cost? This is where careful analysis and consideration come into play. You need to ensure that the higher expense does not disproportionately erode your potential gains. And finally, remember that investing is not a standalone activity. It's part of your larger financial plan. Your investment strategy should complement your income goals and your timeline. Do you have an aggressive growth strategy, or are you moving towards a more income-based fund? The answer to this question will guide your investment choices, so keep these key points in mind, consult with a financial advisor if needed, and make informed decisions that align with your financial goals.